Hello and good morning to you all. My name is Angela Brown and I am a financial advisor at Compass Private Wealth. I would like to welcome you all today, both our Compass Private Wealth clients and also our professional referrals network, to our Economic Outlook webinar. As many of you are aware, this is our 5th webinar in our 10 themes of 2021. To date, we have covered investment markets, retirement funding, protection for me and my family, succession planning. Today, we will provide a macroeconomic update, and in June, we will focus on cash flow planning. Details of our June webinar will follow in due course. So today, we are joined by Jonathan Sheehan, Managing Director of Compass Private Wealth, and also Economist Alan McQuaid. As always, questions can be submitted throughout the webinar by clicking on the question button icon and just submitting the question. And also the webinar itself is recorded and slides will be made available once the webinar is complete. We have a number of slides in our webinar today, which we will be sending to you all once the webinar is complete. And we will be speaking at a high level to cover all relevant topics. So without further ado, I'll pass you over to Jonathan Sheehan.
Thank you very much. Thank you very much, Angela, for that introduction. So, and thank you to Alan McQuaid for agreeing to attend our webinar this morning and share his insights on macroeconomics. Before we go into the economic webinar, I just want to talk about the 8 main pillars of personal financial planning. As any of our clients on this webinar know, that we never look at one aspect of financial planning in isolation. Rather, there's 8 different pillars that we always need to look at consistently and all together. First is retirement planning. As Angela said, we covered that off in a webinar earlier this year. By the way, all of those webinars are available, so contact us if you want to look back at any of those. Succession planning, cash flow planning, which we're covering next month. Asset allocation. I rather use asset allocation to discuss investment strategies, because you need to look at all assets, which includes cash, forms a very important part of the portfolio. So I like to look at asset allocation as the appropriate name for that. Within your asset allocation strategy, selecting the investments is very important. In every financial decision you make, you need to make sure it's tax efficient and cost efficient. Being risk aware is very important. A lot of that is protection, to protect yourself. Protect your financial dependence in the event of death or being unable to earn. It's just like life insurance or income protection. And today what we're talking about is financial education. All of these are interlinked and intertwined. With financial planning, again, you need to look at the big picture before one makes any financial decision or accepts any financial recommendation. You need to firstly understand your existing financial position. And I look at that in 2 ways. Your capital base, which is like your personal balance sheet, the sum of all your assets and the sum of all your liabilities at a point in time. And then secondly, your income and your outgoing. So from a cash flow perspective, what is the cash flow surplus or the cash flow deficit? Nothing wrong with being in a cash flow deficit if you have the capital base built up. That's ultimately what retirement planning is about building up a sustainable capital base, mainly through pensions, in order to draw it down through your cash flow deficit so you can enjoy your retirement. Second point is, once you've ascertained your financial position, is what are your financial goals and objectives? So when do you want to retire? How much of a cash flow surplus or deficit do you want to have? What are your risks? What are your concerns? Do you have an ESG mandate with your investment portfolio? Do you want to carry out certain things? How risk averse are you? How much risk you would like to take? All those types of things. And then once we have your existing financial position and your financial goals and objectives, we ultimately implement the agreed actions from that. So that's it for now from me. I'm now going to pass over to Alan, who's going to speak about the first of his 4 topics on COVID-19 and policymaking.
Thanks, Jonathan. Good morning, everybody, on this pretty miserable day. as Jonathan said and Angela said, there's a lot of slides in this presentation, so I'm not going to go through them all. I started my career in the Department of Finance. Like most of my career, I worked in stockbroking, but at the very start, I was in the civil service, Department of Finance. And in the department, one thing we learned was when you were writing reports, and it's something that I'm very reminded of today during COVID, that civil servants by their nature are very cautious. And you could never, in the Department of Finance, you could never put down a report saying the economy will recover. You have to say the economy might recover. So it's this cautious element to it. And your forecasts, if things went wrong with your forecasts, you always blamed it on the oil price. Oil prices were so volatile that if you got it wrong, it wasn't your fault. Oil prices were the main cause. Now, oil prices are still critical today in terms of economic issues. But in terms of where we are, in terms of forecasting and where the economy is going, the four unknowns are sort of, you want to put up a slide there, Jonathan? I don't know if you can do that. The next one up there. We're now looking at variants, lockdowns, waves and viruses. Now, from an economic perspective, you might, variants and waves are something you might get in econometrics, but certainly lockdowns and vaccines are something that we wouldn't have come across before. Now, it's interesting, if you move on, just at the IMF are saying that vaccine policy is economic policy. So basically at the moment, getting these vaccine rollout is critical. The quicker the vaccines are being rolled out, the quicker the global economy will recover. Now, just as an aside, I was on one of these as a participant, just as tuning in to one of these seminars last year at the start of the crisis, and it was given by the Economist Intelligence Unit. And at the time, this is back in March 2020, at the time they estimated that half the world's population would get the virus. But interestingly, going forward, they were mentioning about waves, second wave, third wave, fourth wave, but their big concern going forward in terms of the potentially the biggest threat to the global economy, social order going forward, weren't the waves themselves, but actually that should get anarchy among the people, that the longer the lockdowns went on, that eventually people would get fed up and do their own thing, and that politicians and governments will lose control. So it's interesting to keep that in mind. But for the moment, it's all about vaccine policy. And I suppose that combined with money being pumped in by the various governments around the world. Now, if you look at where we're at in terms of the US has pumped in 1.9 trillion. Europe has put in much smaller amounts, 750 billion in terms of recovery packages. But these recovery packages have led to a pickup in growth. And if we move on to the next slide, we can see that this is what is expected this year and next. I've used the OECD, the most recent economic indicators from the OECD. You could use the IMF, World Bank, European Commission, any of these institutions. Basically, they're all the same. It's worth keeping in mind that the people who work for these organizations, most of them are effectively seconded from local governments. The only thing is that they don't work on their own desk generally. So in other words, if I'm working in the Department of Finance, I'm seconded to the OECD or move over temporarily to the European Commission or World Bank, etc. I don't work in my own country. I don't cover my own country. But most of these people come over to Ireland. They meet the central bank here. They meet the Department of Finance. They meet the ESRI. They also meet private sector economists, and that's where most of our forecasts come from. So there is a sort of, I don't know what the term for economists is in terms of a head of economists or whatever, but there is this sort of element that most of the forecasts tend to be very, very, very close to each other. So it's not really about the level or the actual figure, it's just really the trend, which way we're going. And you can see from this graph that the OECD in their most recent forecast, they have the central projection is that sort of purple line there in the middle, not as high as the pre-pandemic projection, but still they're assuming that things are going to pick up this year, as I said, mainly because of the vaccine rollout and because governments are putting loads and loads of money into the world economy. Now, I'll come to this point later on, but I mean, pumping this money in, there are going to be repercussions down the road, and there's no such thing as a free lunch, and there's a serious danger that this could turn nasty in the end, from an economic perspective, in terms of what happens, in terms of inflation, etc., going forward. Now you can see here this graph just shows the difference in fiscal policy and health management. The countries that are putting the most in US there, output is diverging. It's putting more money in, so clearly it's going to get a quicker recovery than anywhere else. And if you just move forward, I just point out here, move forward again, Jonathan, there. Sorry, if you go back there, just that last slide was going to show that irrespective of what money is being pumped in, the old adage, or the reverse of that now applies. The old adage was that if the US sneezes, the rest of the world catches a cold, I suppose, or excuse the pun, this time probably catches COVID, but God forbid. But the opposite applies as well, that if the US is doing well, the rest of the world will follow. So the fact that the US is pumping so much money in, clearly it's going to boost its own economy, but it'll also boost the rest of the world too. So the baseline scenario for this year and next year is that things are going to recover, and in some cases quite strongly. So if we move forward to the next set of slides, this is what the US economy got off to a very, very, very positive start. Now you can see there 2 quarters ago, massive growth rate of 33.4%, but we're more normalized the first quarter this year, 6.4. That's the second highest growth rate in the US has had since the second quarter, since the third quarter of 2003. And the US is on course to post its highest annual growth rate for 4 decades this year. So as I said, if the US is growing strongly, that's a positive for everybody else. Now, the second strongest economy, or the second biggest economy in the world, is China. Now, at the start of this crisis, a lot of speculation or rumors about whether this virus is man-made or not. But irrespective of whatever China is up to, it has posted its highest growth rate ever. When I say its growth rate ever, I mean they only have data going back to the early 90s, recording this data, but it's the highest growth rate ever in the first quarter. So again, the 2 biggest economies, US and China, growing strongly. That augurs well for the rest of the world. But keep in mind, it's something I'm going to address later on. China is the biggest consumer of commodities, and if China is growing strongly, there's every chance that demand for commodities will increase, and that in itself will have huge implications for the prices of commodities and in turn for inflation, which is a main topic of conversation in financial markets at this point in time. Now, if we move further ahead, the Eurozone hasn't been so good in the first quarter. Germany, Italy, Spain all contracted. France actually grew. It was the only one of the big 4 that grew in the first quarter. But this is more to do with lockdowns, how severe they were. France was a bit slower to lock down, kept its economy open a bit longer than the rest. But with Germany, Italy, and Spain are all expected to bounce back in Q2. It's worth pointing out too that we had figures earlier on the week from Japan. Japan contracted as well in Q1. So did the UK. But as with the Eurozone, most of these economies are expected to bounce back in the second quarter and further on throughout the year, assuming that there's no sort of lockdowns and clearly this concern about the Indian variant, etc. And assuming the Indian variant doesn't deter or limit the amount of vaccines and the vaccines can work against the Indian variant, there's no reason why the global economy won't bounce back strongly over the remainder of the year. This graph just points out the composite PMI, the Purchasing Managers Index. For those of you who don't understand these indices, if the figure of 50, the 50 line, 50 is a neutral line there. So anything above 50 says the sector is expanding. Anything below says it's contracting. This composite PMI shows that in the second quarter we're above 50, so that everything is the economy in the eurozone has started to expand again, which further adds to the argument that after a slow start in Q1, we're going to get a strong bounce over the rest of the year. We move on again to the next one here. This is the JP Morgan Global Composite Output Index. You'll see the first thing you'll see there is the strong correlation between the two lines. The orange line there is GDP growth, and the green line is the actual index itself. Again, they have the 50 line there. Anything above that, the output is expanding, and the April figure for the composite output index for the world hit an 11-year high. So, again, all things being equal, and notwithstanding the obvious concerns about the virus and that it's contained, we are going to bounce back pretty strongly over the remainder of the year. Now, it's interesting, I mentioned later on about the level of stimulus being pumped in, US with huge stimulus. It's interesting to note that the US, according to the OECD anyway, is the only country that they expect to outperform its pre-pandemic growth projection. So that at the end of the quarter four in 2021, it'll be the only one, even with the global economy recovering, will be the only one, according to the OECD, that will have a stronger growth rate than that was projected before the pandemic hit. But again, that reflects the amount of money that's been pumped in. We're looking at, as I said, 1.9 trillion in the pandemic sort of support. And don't forget, we're also going to have a huge infrastructure package as well in the States. When you're talking about a quarter of national output, 25% of GDP in terms of stimulus, which is going to have a huge impact on that economy. So if just finally there, we move on, we're going to see that they're the projections for next year. All pretty strong. You'd expect India and China, which normally have huge growth rates, but the US, as I said, 6.5. You'd have to go back nearly 4 decades to get a growth rate that strong. So I think it's a positive, and I think the issues, hopefully that this growth will lead to a return to work in most countries, but clearly there are going to be effects in terms of the labour market for some time to come. And just there, I think just this graph from the OECD, just really, if you look at the green and orange sections there, really the green section is, they're comparing their latest forecast, which they did in March, to the previous quarter at the end of December. And in most cases, the orange section points to a downward revision. The grey sort of line is no change, and the green is an upward revision of a quarter percentage point or more. And you can see in most cases, most countries have higher forecasts for this year, next year, than they would have had at the end of December. So I think at that we're going to hand back now to Jonathan, I think.
Thank you very much, Alan. That was quite optimistic, and it looks like the negativity that we experienced in 2020, and particularly the first half of the year, is becoming more and more positive as we look forward into the rest of 2021 and the rest of 2022 on a global basis. I'm just going to do a short section here on investment markets, just to give you an overview as to how the economic background is feeding through into investment markets. So I split up markets into 5 different sections. The first is on interest rates. So remember that the prevailing interest rate from a central bank is really what the risk-free rate of return should be benchmarked against for investors, be it through your pension or through your investment portfolio. In recent times, we've actually seen deposit rates turn negative, and this may be something Alan can touch on later on. Something that we're certainly not familiar with. Bank of Ireland recently wrote out to clients warning that over the summer, negative rates would be in place for deposits over $1 million, but all big European international banks have already put this in place. So it's a more challenging environment in terms of interest rates. Bonds which are linked to interest rates are at all-time lows as well. So yields have been negative, for example, with government bonds. But over the last couple of months, we are seeing a slight tick up in, say, the 10-year German bond, which is actually still negative, but it's less negative than it had been. Same goes for the US and other big economies. So bond yields have ticked up. And the reason why bond yields would tick up is because there is an expectation that there will be inflation in the future, which is what Alan will speak about in the next section. We can have a full 45-minute webinar about equity markets. We have covered it off in our January webinar, but do ask any questions if you like. But I suppose if I was to summarize, we've seen unprecedented volatility over the last 15 months or so. We saw the shortest, sharpest sell-off in the history of stock markets in February or March of last year. And since then, we've seen a recovery with a few highs and lows, but pretty much every global equity market has actually recovered the losses from the first quarter of last year. And it does underline the rationale of it's time in the markets, not timing the markets, having a long-term perspective. If you have capital invested in the markets, you have to have a minimum of a 5-year time horizon, so that short-term volatility and sell-offs shouldn't impact on the long-term plan. Property, we've seen a big disparity of returns. Irish residential property has been unaffected completely by what's happened in COVID in terms of the values of Irish residential property. Commercial property has been more varied. Certain commercial properties have done very well out of it, such as logistical warehouse type properties, but city centre Georgian buildings, where our building is, for example, would obviously be impacted negatively because of maybe a higher vacancy rate for that type of property, and obviously retail has been impacted negatively. And the last section just on alternative investments. So I won't talk too much about the likes of cryptocurrencies, but ultimately there is rationale for having some element of an absolute return strategy in a portfolio, but you just need to be very careful as to what your expectations are and what the risks are with that particular strategy. So there's been a lot of volatility in relation to gold and mainly cryptocurrencies over the last while. This graph here is 8 of the major stock market indexes and how they performed over the last 3 years. And I've gone back 3 years because the picture paints 1,000 words, and it does show how 2019 was a very strong year for equity markets. And you can see here the extent of the sell-off that every market experienced in those 4 weeks from the end of February 2020 to the end of March, and then the extent of the recovery that we've seen. If you see the yellow line there, which is the outlier, that's the US S&P 500, which is up 55% in euro terms over the last 3 years. That compares very favorably to, say, the FTSE 100, which is actually pretty much flat over the last 3 years. And then even Europe, the likes of the German market, is only up 15%, which is about 4.5% compounded up over the last 3 years. Key principles: diversification. Clients of mine will be sick of me talking about diversification, but it's just so important. Holistic view, so always look at all your assets holistically in aggregate. Don't ever look at just your pension without considering your spouse's pension or your non-pension assets or corporate assets you might have. Make sure you have a clear mandate, that you understand exactly what you're investing in, full transparency on everything with your pension or investment strategy. Don't fall foul of inertia. So if a recommendation or an action makes sense, I would suggest just do it, and rather than not making the action for rash reason of paperwork or whatever it might be. And finally, always avoid conflicts of interest. Okay, I'll hand back to Alan now to talk about interest rates, inflation, and central bank funds.
Okay, thanks, Jonathan. This is probably the most important part of the my presentation, because what's happened, I mean, Jonathan's mentioned there, and you're all aware, I'm sure of it, you are aware of the negative interest rates and the zero returns on deposits in banks. Inflation is something that has puzzled economists for a long time, particularly after the financial crisis. Because after the financial crisis, we had a situation where, again, where central banks around the world were pumping loads and loads of money into the economy. Unemployment levels fell. A lot of developed countries like the US, Ireland, etc., UK fell to record lows. Yet wages didn't go up dramatically, and inflation didn't go up dramatically, and people were sort of scratching their head as to why inflation never took off or didn't take off back then. I suppose the arguments that people used, one is demographics. I mean, demographics, as countries or the people get older people tend to save more and spend less. So the demographic factor is possibly one of the answers. And two, the other big sort of suggestion we've been put forward was that we moved to a new age, technology age, where technology was pushing prices down. So we never really got an answer as to why inflation never took off. But what's happening now with this latest, with the pandemic and the flood of money coming in again, is that inflation suddenly has picked up dramatically. If you look in China, Chinese producer prices are at a 3-year high, and in April in the US, the annual inflation rate, that's the difference between April this year and April last year, hit its highest level in 13 years. So is inflation taking off at last? I suppose what you could argue, the issue with inflation is this time around is that there's every chance that we're coming to an end of globalization. I've another slide there on Eurozone. Eurozone inflation on the rise as well. It's on the rise in the UK. But the point being that, if you look at the Trump era, Brexit, the tariffs under Trump, there's an element of the end of globalization. We're seeing it with the sort of the policies introduced through COVID, with every country doing its own thing. You can see it here at home with the locking down, the quarantining in the hotels. Ireland really is a member of the EU, but still doing its own thing to protect itself. So we're sort of moving away from a globalization model, and that in itself has inflationary risks. Plus the fact that people have been locked away. I think people feel as if, oh, I want to get out. There's pent up demand. They're going to push up prices irrespective. They don't care what the price of a good is now. They just want to spend it. I mentioned oil at the very start. Oil prices, they're way off what they were back in 2008. I think in 2008 they were $147 a barrel in July 2008. But in terms of inflation, it doesn't matter. What you're measuring in inflation is 1 year against the previous year. So the cost of Brent oil at the moment is $65 a barrel. That's what it was in April. But it was only $18 a barrel back in 2020, in April 2020. So it's effectively more than 3 times what it was a year ago. So that's going to be inflationary. So the question is whether there are clearly base effects at work here in inflation. But there are also, I think, the other elements. I think because of COVID, a lot of firms have gone to the wall. A lot more are probably going to go to the wall before this whole thing is over. And that in itself produces supply constraints. So, the less availability of goods in terms of less being able to supply it. And don't forget, we also had the issue with this Suez Canal where ships are blocked off from getting goods through. Anything that impacts on supply ultimately is going to hit prices. Now, the question is whether it's transitory. I think the Federal Reserve in the US says it's transitory. They think inflation's only here temporarily and it won't take off. I'm not too sure. I think we've moved away. I think there's every chance that inflation is going to start to pick up. And if inflation picks up, we are again going to see more likely the end of zero interest rates and deposits starting to pick up. But the downside is that the central banks cannot afford to raise interest rates quickly, because if they raise rates quickly, they're going to stymie the recovery, and that's something they can't afford to do. So they are really dug themselves into a hole, and how they get out of it is going to be very difficult. I think at the moment, as I said, the central banks in the US and Eurozone have said that they're going to let the economies run hot. That means there's not going to be any rush to raise rates. But ultimately, if inflation takes off, and don't forget that in the Eurozone, the principal objective of the ECB is to maintain price stability. So if inflation takes off, they really have to respond by raising rates. Now, just in terms of the bond yields, Ireland at the start of the year, 10-year bond yield was negative. We're now at 0.33. So it's going up. So the cost of Ireland having to raise money on the markets is getting dearer every month. And that in itself has implications. Like at the start of the COVID crisis, it's fine. We can run up as much debt as we like because there's negative interest rates. And rates are still, even at 0.33, they are historically very, very, very low. But the danger is if inflation takes off, you're going to see that rate of 0.33 head up, head north, and get past 1, get past 2 quite quickly. And that in itself has serious implications for the sovereign in terms of having to fund the huge level of debt that it's run up in the last year or so. So just to explain quickly, in case you don't know, I mean, obviously inflation is the biggest enemy of the bond market. Because just to explain, if I was to lend Jonathan €1,000 and over 10 years, and then in 10 years he pays it back, but in the meantime inflation's risen dramatically. The value of the money is, for me, my €1,000 in 10 years time, the spending power I have in that has decreased significantly. So bond investors, if inflation starts to pick up, they will want a higher interest rate to lend to sovereigns or whatever. Now, there's always this argument that, inflation is great, you can inflate your debt away. That's fine to me, yes, that's a good argument. And people will say, if inflation ticks off, that makes it easier to pay back our debt. That's fine if you're just clearing your debt off. I owe someone €100, I have to pay back over 10 years. I can clear in 10 years. But Ireland is rolling over its debt. It's constantly rolling over its debt. We're not paying it down. We're just rolling it over, rolling it over. And if you're rolling it over, inflation then becomes a problem, because every time you roll it over, it becomes more expensive to borrow money. And that's the danger that we have. So while inflation in some ways has a positive element to it, if you're rolling over your debt constantly, it's got a negative knock-on effect. Now, as I said, zero interest rates, probably here to stay for some time. I mentioned with another Zoom I was on last year. It was hosted by Patrick Honan, who was the former governor of the central bank here and obviously a member of the ECB at the time. And the guest speaker was Lewis de Gundas, who was the current ECB vice president. And I think you could imply from the conversation they were having that the ECB would be willing to let inflation run above its 2% target for some time. In the last 10 years, they've been effectively running below target, so they're willing to let the target run above that temporarily just to get it up, which implies that rates will be zero for longer than you may think. But I still my own underlying feeling is that if inflation picks up dramatically and continues an upward spiral from here, they will be forced to act quicker than the markets are pricing in. So in other words, if inflation continues to go the way it's going, or it's gone the last couple of months, if that continues like that over the next year, you will see central banks responding with higher interest rates. And the question then is how high they go. So just on Ireland, I just want to make a point, something about Ireland that people always ask about the Irish interest rates. We have obviously higher interest rates, mortgage rates than the rest of the Eurozone. We also have a lower deposit rate than what the others would give. But I think to point out to you just a couple of facts there. The return on equity for Irish banks at which is a measure of profitability, was minus 5.2 for Irish banks at the end of the third quarter last year, the last time for comparable data. That compared to an EU average of plus 2.19. The core tier equity capital ratio, which is what the banks are required to hold. This is a result of the financial crisis. 19.1 in Ireland. The Eurozone average is 14.4. But I suppose the most important one, and one that banks always used to, when I was working in stockbroking, used to come in and cite as the main reason, is the repossession of homes. The legal process of repossessing a home in Ireland can take up to 42 months. That's 3.5 years, compared to 18 months in the likes of Denmark, Norway, and Sweden and the UK. So that in itself is a key reason why rates are higher here. And until that process changes, particularly in terms of repossessions, you're not going to see Irish rates, come below or get back to the Eurozone average. They're going to remain higher than the Eurozone average. Okay, I think just finally, I don't know what we're running out of time here, we'll run over course. Just quickly on Ireland, I mean, just a couple of quick points. Ireland, we were the quickest growing economy in last year, or the only growing economy in the EU last year. So despite COVID, we posted positive growth of just under 4%. I think, again, well documented, a two-tier economy here, or what people call this K recovery, driven mainly by the export performance of the Medipharma and the IT sectors. In contrast to that, the indigenous sectors badly hit. 54% fall in arts and entertainment, massive falls too in the hotel sector, and construction was down 13%. But interestingly as well, even though we were the highest performer or the best performer overall last year, we were the worst performer in Q4. But again, that was more to do with the intellectual property rights, or how they're measured in terms of the multinationals, more than anything to do with the SME sector. Total hours worked and all this. The only sector really that that saw improvement in employment last year, even though growth was up and productivity was up, the only sector was the IT sector. So again, that highlights the divergence between the SMEs, which, remember, are the biggest employers in the state, and the multinational sector. And IT, and I think one of my concerns going forward is this notion that working at home is going to take off big time. Working at home is going to increase productivity. It may do in some sectors. I think definitely in the IT sector, it's a positive, because the very nature of IT, a lot of work is done from home. A lot of that is, you're going to call, computer nerds who write software. They don't, software programs. They're happier to be, in their bedroom, working all night, writing programs than going out socializing, etc. So I think IT will definitely benefit from working at home. In the public service, I think it's going to be an absolute disaster. That's my own personal opinion. So I think you'll get less productivity in the public service, in my view. And I think you'll see the gap widen between the haves and the have-nots. I think the haves will expand. They'll have more. The IT sector will grow stronger, and the indigenous sector will grow weaker. And bear in mind as well that despite all the concerns about Brexit and our exports, 70% of our exports are multinational, are driven by the Medipharma and IT. So even though we have a huge indigenous sector, and nearly half, or just under half, of our food exports, we're going to the UK, etc. Most of our exports are multinational, are IT and Medipharma. Again, this graph that Jonathan is holding up there, you will see that the only tax return or tax sector that actually grew last year, with the exception of I think stamp duty, there was an exceptional item there. The only section or area that increased was corporation tax. So 8.7% increase in corporation tax, again highlighting the importance of the multinational sector. Going forward, there's obviously concerns about the change in corporation tax rules, digital tax, whether we may have to raise taxes here. Clearly, anything that hits that sector, or that hits corporation tax and hits the multinationals, is bad news. So the risks for Ireland, I think, while there's no doubt that we should benefit this year from the US recovering and the global economy being stronger. I think there are clearly risks going forward. We have a massive unemployment rate now. The COVID adjusted unemployment rate for the under 25s is 62%. I mean, 3 in 5 people under 25 out of work is just shocking, as Roy Keane would say. You have the graph there we put up there that that Jonathan had there, that the Department of Finance is predicting. That's their latest forecast there, 18.7 last year. They're saying 16.3 this year, down to 8.2 next year. I think, personally, I can't see it falling in single digits next year myself. I think there's a lot of damage been done to the economy in terms of, when we do try to open up, I think a lot of businesses are going to go to the wall. So I think unemployment is going to remain higher than 8.2 next year. So it's going to be a slower process in getting down. So while I think the economy is going to recover, I don't think we're going to go back to the heady days of the Celtic Tiger by any means. And I think the danger, the risk is that during the financial crisis or post-financial crisis, the big surprise was that we recovered quickly than most people assumed. I think the danger this time that the recovery may be slower than what people are assuming. So I'm optimistic generally on the economy. I think Ireland is going to recover too, but I think it'll be a slower process than many are assuming. I think interest rates look like they're going to start moving up now, and that in itself has serious implications for not just for the economy but for investment markets too. So,
thank you very much, Alan. That was very insightful, and I think we had over 60 slides in total there, and we will be sending out all the slides afterwards. And there's unbelievable detail in each of those slides, with really good sources, really strong insights. So, Alan, thank you very much for that. And hopefully, we have a few questions now. We have about 4 or 5 minutes. Just have one question here. It's an interesting question. It asks about cryptocurrency and Robinhood and that type of speculative trading that we've seen in terms of the Robinhood thing, more so in the US, obviously, but in terms of the takeoff of things like cryptocurrency, and what should people be aware of? Alan, what's your view on it? What are the risks? What do you think?
I think I think I don't know if the slide is still there. One of the slides I did originally for the seminar, I think at the end of the first quarter, one of the most interesting things was that the demand for Bitcoin was stronger than demand for gold. If you think of gold is actually seen as a safe haven in time of crisis, so the fact that the demand for Bitcoin was stronger, I think says it all. Now, I don't know enough about cryptocurrencies, but what I would say is I think Bitcoin is here to stay. If I was going to invest in any cryptocurrency, it would be Bitcoin. I think it's the father of those currencies. The other ones I'd be worried about. I mean, the idea that we had, I call it doggy coin, but I think it's called Dogecoin. And the fact that a parody, which was practically a parody of cryptocurrencies themselves, actually took a life of its own and hit record highs earlier this year before Elon Musk intervened and sort of made some comments about it. So I think there's 2 elements to this. One, what worries me slightly is that all this money being pumped in, we're getting sort of artificial sort of people just buying these things on a whim, which worries me. Things like Dogecoin, and the fact that people like Elon Musk just coming on to Saturday Night Live in the US and making comments and bringing markets down, it was a worry in itself too to me. But in terms of, if someone asked me, do you want to invest in cryptocurrencies, my answer would be, I don't know enough about them, but I think that there seems to be enough life in Bitcoin. If I was going to invest in one, I think Bitcoin is the one that's here, certainly for the immediate future. There may be one down the line that takes over from that, but Bitcoin would be one I'd go with. It's had a rough ride in the last while. But I think they're here to stay. I think it looks that they're here to stay. So if you're into that sort of thing, you want to do it, I tend to go for Bitcoin if I was going to do anyone,
Another question has just come in here, a local question in terms of what's happening this week in Ireland with the stamp duty on the 10 houses above in terms of vulture funds coming in and buying more than 10 houses at once, 10% stamp duty. And what's your view on that, given that we need, on the one hand, to attract in institutional money in order to provide the demand for the supply as such, but equally first-time buyers aren't getting on the housing ladder because of these funds. So what's your view in terms of the issue, firstly, and secondly, the action that the government have taken?
Well, two things. I have a slide there on the property market. One thing, just going back to the point I made about working from home. If working from home becomes takes off seriously over the next few years, then the first thing is, I think properties outside Dublin will rise quicker. I mean, they are, I think, at the moment, but they will. I think demand for property outside Dublin will probably rise quicker than in Dublin. I think so. Prices will go up higher. On the property market, I think my view of this is, look, government policy, you've got to decide what you see a house as. I'm not a residential. I'm not talking about commercial property. I'm talking about a house as a dwelling. What is your aim? Do you want it as an investment vehicle, or do you want it as, a house should be there for someone to live in? If a house, that's the first thing you have to decide, as politicians, what do we want? If housing is there that people who want to rear a family and buy a house, then policy should be geared towards that. And you have to implement, you've got to hit the vulture funds quickly, tax them, and not only tax vulture funds, you've got to tax back people who own multiple houses. You don't need 7 houses. Okay, you might get a house. I mean, for most people, you buy a house, to live in. You might inherit at the same time, inherit your parents' house when they die. So you could possibly have 2 houses, right, at some point, because of circumstances. But you don't need 7 or 8 houses and keeping people out of it. And the other thing is, a lot of these politicians are landlords. You cannot. I mean, the first fundamental thing is landlords should not be allowed to go for public office. If that's my view on the housing market. I mean, if you seriously want to look after young people and get them into a house, then you implement policies. You were able to implement policies during COVID, which in many ways, infringed on civil rights, and there was no, you passed them through quite quickly. Well, there's no reason you can't do it here. And say, if you own 4 houses, pal, you're not getting a house anymore. You don't need it. Let this to people who need a house. They're willing to pay the money for it. Let the government subsidise the builders if they have to, and get everybody who wants a house onto the market. And then you can, if there's more extra houses, then you can, available, let the people who want 5 or 6 houses, buy more. And then, but there's no easy solution to this. I know the point you're making as well, that you need sort of landlords for the rental market, etc. But I think fundamentally here we need to see what do we see a house as? Do we see it as an investment vehicle, or do we see it as, getting young people who want to get on the property ladder, get them started, and that's our main goal. And for the Fianna Fáil, that is their main goal now. Well, then you've got to implement tax policies, not just on vulture funds, but on people who own multiple houses, and hit them hard. And but there's always a solution to this. I'm not, I can see the other side of it, but if Fianna Fáil, if that's what Micheál Martin's policy, and he seems to say that's what they're worried about. Social housing is one thing, but again, we're looking at, we've ignored an age cohort of 18 to 30, maybe 18 to 35. People who are working, or doing an honest day's living, who want to get a house, and have just been ignored. And every policy is either geared to people who don't work, or people who have loads of money, and the people in the middle are just being ignored. And
just the final question. I know we've got a couple of minutes over, people, but the webinar is being recorded, so if you do have to sign off too, so we'll send you the link afterwards. The final question is, a lot of people are saying that because of all this surplus savings that people have through the pandemic, that's going to create inflation, or will contribute towards inflation. But the question is, how long will it contribute for? Will it be a short-term thing for the first 6 or 12 months where people will spend the surplus savings and then things will level out? Or do you think it could create a sustained level of additional spending and therefore higher inflation?
I think if you look at the during the financial or post-financial crisis, we hit record savings irrespective of pandemic. Rates were ultra low then, and people still saved. I think the jump in the last year has been something like 16 billion. I think we're now 128 billion in deposits. I think you're going to see some sort of pent up demand. You'll see some of that money spent in the next few months. I'm not convinced you're going to see the 16 billion being rolled out by any means. I think there's an element of, I think people are cautious in many ways. I think many people may well be saving for that house, that they want to try and get the house. But I think people were bitten, it's once bitten, twice shy. Now we've been hit twice with sort of major crisis this century already. And I think people, I do think there'll be an element of, as I said earlier on, getting out of prison. Let's go and enjoy ourselves. And there will be some spending. I don't think we will see a massive sort of. I don't think that 16 billion is going to be spent in the economy by any means. But I do think inflation. I think inflation is going to be higher than what it was. I do think more so the end of globalized. I think we're moving away from a globalized world. I think the whole Brexit thing, as I said, the Trump thing. I think Trump hasn't gone away, and that's the policies in America first. Biden might be only keeping the seat warm for the next Republican to come in and implement those policies. So I think inflation is going to be higher. Now, how high it gets, I don't know, but clearly the higher it goes, and the Federal Reserve is very relaxed about this, but the higher it goes, the quicker they're going to have to respond to it, and they're going to respond through higher rates. But the problem they have is if they raise rates dramatically, that's going to do a lot of damage to the economy and then and to financial markets. I think the last time, real interest rates of 1% in the US had the US stock market in an absolute frenzy, in a downward frenzy. And we've got negative rates now, so we've a long way to go to get to 1%. I mean, if you have an inflation rate of 4 or 4.2, to get to a positive rate of 1, a real rate of 1, you need a nominal rate of 5. So we're a long way from that, But I think inflation is going to be higher than what it was. So I think the movement in yields, etc., I think is more likely to move higher than lower over the next 6 to 12 months, anyway.
Alan, that's really, really useful and insightful. Thank you very much for joining us today. Thank you for your contribution. Thanks for the slides, which we'll send out. Thanks to all of you, our attendees, who've taken the time out in this very wet morning to join us today. Wish you all a lovely day, a lovely weekend, and we'll talk to you all soon. Thanks again, Alan.
No, you're welcome, John. Thank you.